Welcome back to the deep dive. So today we've got the latest investor docs, specifically their November 2025 investor presentation, and that Q3 25 10Q filing.
Yep, got him right here.
And we're diving deep into, well, this key infrastructure company, the one designing and building the internal nervous system for the world's biggest cloud and AI factories.
Right. And our mission for you listening is pretty straightforward today.
Yeah.
We really need to unpack how this company just engineered this takeover in high-speed switching. What's really going on with their strategy, especially that heavy reliance on the, quote, cloud and AI titans.
Yeah, that concentration.
And crucially, what risks are they taking on as they push so hard into this, well, volatile AI networking space?
Okay, so let's ground this first. Their core business, their fundamental value prop, it's all about networking solutions, right? Centered on their extensible operating system, EOS.
Exactly. EOS.
Yeah.
And maybe for someone who doesn't, live inside a network rack day to day, why does EOS matter so much? Well, it's really the key differentiator in this hyperscale world we're in now.
Okay.
EOS lets these massive cloud providers automate and manage enormous networks, think millions of connections, and do it seamlessly.
So stability and automation at scale.
Precisely. Flexibility, intelligence, high availability. It's exactly what a giant like Microsoft or Meta needs to just keep scaling without, frankly, falling over.
And they deploy that system across their main platforms.
Yeah.
Switches, routers.
Correct. Ethernet switching and routing platforms.
Yeah.
Targeting AI, data centers, but also campus networks and routing environments now, too.
Okay, let's talk trajectory, because it's not just like steady growth. It feels more like market disruption.
Oh, definitely.
Think back. They went public in 2014. Revenue then was, what, $838 million?
Yep, just under $1 billion.
Fast forward 10 years, 2024, and they hit $5.8 billion. I mean, that kind of jump in a pretty mature hardware sector. It tells you someone else is losing ground.
That's the key point, isn't it? Their growth curve basically maps onto the rise of the modern hyperscaler. They weren't just lucky, they timed it.
How so? What were the milestones?
Well, they really doubled down on this market with key software moves, like CloudVision back in 2015. That gave the big players the network automation they desperately needed.
Okay, software first.
Then came the hardware muscle, the rapid rollout of 400G and then 800G products, keeping pace, even leading.
Right.
Followed by the official launch, just last year in 2024, of their dedicated AI networking stuff. They've managed to align their innovation cycle almost perfectly with the cloud titans' spending cycles.
But they weren't the obvious choice initially, were they? I mean, Cisco had such a legacy hold on networking. How did this relatively smaller player muscle their way into the biggest data centers on the planet?
Yeah, it's a classic disruption story. You look at the market share numbers. Back in 2012, they had, maybe 4.9% of the data center switching market? Tiny.
Barely a blip.
By 2024, 29.2%. That makes them number one, the leader in data center switching.
Wow. Okay, how?
It boiled down to focus and philosophy. They zeroed in on open standards. You see, hyperscalers crave flexibility, and they need to control costs massively. Proprietary locked-in systems. That works against them.
Right.
This company came in offering advanced standards-based tech, rock-solid reliability that was huge, and automation that slashed the need for expensive manual work.
So they gave the cloud giants what they were asking for.
Exactly. Control over their own infrastructure destiny, essentially.
Okay, let's pivot to the present day, the Q3 fiscal 25 numbers. Because of that revenue breakdown, it really highlights just how much they lean on that small group of massive clients.
It absolutely does. It's stark, really. Somewhere between 40% and 45% of their total revenue comes just from those cloud and AI titans.
Almost half their business from a handful of companies.
Yeah. Then you've got enterprise customers, that's about 35% to 39%. And then service providers, telcos, and the like, making up the rest 20% to 25%.
And that customer mix must drive the geographic split too, right?
Completely. Look at Q3 25. 60% to 65% of sales were in the Americas. It makes sense. That's where the titans are headquartered, mostly. EMEA and APAC, they lag way behind.
So the whole rhythm of their business basically pulses with the spending decisions of a few U.S.-based tech giants.
That's a good way to put it.
Now, looking at what they're selling, their traditional bread and butter core data center and cloud networks, that's still the biggest piece.
Still the core, yeah. Around 60% to 65% of revenue. But where you see their expansion strategy playing out is in what they call cognitive adjacencies.
Right, the buzzwords. What does that actually mean?
Yeah. Stripped down, it's their newer growth areas, campus networking and routing. These now account for 20% to 25% of revenue.
Okay, so they are successfully pushing beyond just the data center.
Definitely.
Sure.
And then you have network software and services making up the final 10% to 15%. That service piece is important too.
Okay, let's focus on the big bet they're making right now, this push into the AI market. It seems like they have a two-pronged strategy here.
Correct. First prong, hardware. It's a big hardware play. They're delivering Ethernet switching that's designed to be super scalable, lossless, meaning no drop data packets, crucial for AI and high bandwidth. And it's engineered specifically to connect these huge clusters of GPUs, compute, storage, everything you need for training generative AI models and running those massive workloads.
And this puts them head-to-head with InfiniBand, right? Which has kind of been the gold standard for this stuff.
Exactly. That's the critical battleground. They are directly challenging InfiniBand's established performance dominance in AI networking.
So why bet on Ethernet for the AI core? InfiniBand is built for that low-latency, high-performance compute world. What's the potential upside and what's the risk?
Great question. The potential reward, it's massive. Standardization, leveraging the huge existing Ethernet ecosystem, scale. If Ethernet can prove it's good enough for these enormous AI clusters, meaning, minimal packet loss, super high speeds, even if latency isn't quite InfiniBand level, then the cloud titans win.
Awesome.
They can use existing network engineers, tap into potentially better supply chain costs, enjoy the flexibility of an open standard, basically avoid getting locked into proprietary InfiniBand systems. That's the dream.
And the risk.
The risk is simply physics and performance. If the absolute lowest latency remains paramount for the most demanding AI training, Ethernet can't quite match InfiniBand there, they could get shut out of the really high-end, cutting-edge AI builds. It's a fundamental technology fight playing out right now.
Okay, so that's the hardware bet. What's the second part of their AI strategy? Software.
Exactly. Software to manage all this new complexity. That's where something called Arista Autonomous Virtual Assist, or AVA, comes in.
Okay.
It uses natural language processing, NLP, to help with AI-assisted operations, observability, network security, basically using AI tools to manage the AI networks they're building.
Makes sense. Building the tools to manage the infrastructure.
And tied into this expansion, we also saw that strategic move back in June 2025. They bought the VeloCloud business from Broadcom for, $300 million cash?
Right, the SD1 piece.
Yes, significantly boosting their cloud-wide area network portfolio. So they're clearly trying to diversify their value, broaden their reach beyond just the data center switch.
Okay, let's anchor this strategy discussion in the actual numbers from Q3 2025. They reported total revenue of $2,308.3 million. That's a solid 27.5% jump year over year.
Pretty robust, yeah. And what's really interesting, and maybe a sign of long-term health, is that service revenue growth, $396.6 million.
Which was up how much?
Up 38.1% year over year. That's a big deal because that recurring subscription-like revenue gives them a cushion against the ups and downs of hardware sales cycles.
Good point. And profitability looks strong, too.
Very strong. GAAP net income was $853.0 million for the quarter, and non-GAAP gross margin held up really well, 64.6% in Q3. Healthy margins.
So, strong quarter. What's the crystal ball saying? What's the forward guidance tell us about the next year or so?
Well, for the full fiscal year 25, they're projecting revenue growth around 26% to 27% year over year. That signals they expect continued heavy spending from those big cloud and AI customers.
And margins, are they expecting those to hold?
Pretty much steady for FY25. Non-GAAP gross margin around 64%, similar to Q3, and operating margin around 48%. So continued strong performance expected this year.
Okay, and then looking out a bit further into fiscal 26. The projection there is still strong growth, but I noticed a slight shift in the operating margin outlook.
Good catch. Yeah, they're projecting continued solid revenue growth for FY26, somewhere around 20% year over year. Still very strong.
What?
But, as you saw, the non-GAAP operating margin is guided slightly lower, maybe 43% to 45%. Now, this small dip, I don't think it's a red flag.
Okay.
It looks like the strategic cost of that big AI push we were just talking about. It suggests they're deliberately ramping up investment R&D, supply chain capacity to really go after that massive AI opportunity. They seem willing to accept a temporary slight squeeze on margins to cement their technical lead.
Investing for future dominance, essentially.
That seems to be the play. And they certainly have the cash to do it.
Right, that balance sheet looked pretty hefty.
Oh, yeah. Huge war chest. Total cash, cash equivalents, marketable securities. It hit about $10.1 billion as of September 30th, 2025.
Wow. And how are they planning to use that cash?
Well, their stated capital allocation priorities really scream growth. Strategic M&A is on the table if the right opportunity comes along. Big investments in their existing operations, especially shoring up that supply chain for the AI demand.
Mm-hmm.
And, of course, returning some capital to shareholders via stock buybacks. They authorized a new $1.5 billion repurchase program, and as of the end of Q3, they still had about $1.4 billion left on that.
Okay, so we've painted a picture of a company that's financially strong, strategically pretty dominant in its core market. But let's peel back another layer. That customer concentration we mentioned earlier, how stable is that foundation, really? This is where I think it gets really interesting, maybe a bit precarious.
It is precarious. The risk here is pretty profound, honestly, because their fortunes are so tightly lashed to the quarterly spending decisions of literally just a handful of giants.
Can we put numbers on that again?
Yeah, the filing states it plainly. For the full year 2024, sales to Microsoft were 20% of their total revenue.
1/5 of the company's sales to one customer.
And Meta Platforms, Facebook's parent, was another 15% of total revenue in 2024.
Okay, so add that up. Over a third, 35% of their entire business relies on the purchasing whims of just two companies.
Exactly, two companies. So what's the practical consequence? Beyond just the obvious revenue ups and downs.
Yeah, what does it mean for running the business day to day?
Well, it makes forecasting incredibly difficult. Any delay, any budget cut, any shift in hardware strategy by just one of these titans can cause material swings in the results from one quarter to the next. Huge uncertainty in timing.
Right.
And there's another layer of risk explicitly called out in the filings. The risk that these customers might just overestimate the initial demand for these massive new AI build-outs.
Ah, the hype cycle risk?
Kind of, yeah. They might get overly optimistic, place huge orders, and then later have to scale back or even cancel commitments if the adoption curve isn't quite as steep as they hoped. So that AI boom could potentially hit a sudden air pocket.
And feeding into that risk, to meet this potential forecasted demand, which, as you say, is volatile, they've had to place enormous bets themselves, right?
Right.
With their own suppliers.
That's the other side of the coin,
Yeah.
and it's a really high-stakes gamble. They have massive, non-cancelable purchase commitments for components and manufacturing capacity.
a massive.
As of September 30th, 2025, total future non-cancelable commitments stood at $4.8 billion.
Whoa, nearly $5 billion they're on the hook for.
And get this, $4.3 billion of that is expected within the next 12 months.
Okay, that's huge exposure. Why such big commitments?
It's driven by trying to secure the necessary components for this anticipated AI deployment ramp-up, plus dealing with ongoing extended lead times for certain critical parts. They have to place these bets to be ready.
But the risk.
The risk is obvious. If those customer demand forecasts turn out to be wrong, if the Titans pause or scale back, they could be stuck holding the bag. It dramatically increases the risk of having to take massive write-downs for excess and obsolete inventory. It's a very sharp, double-edged sword.
Okay, one last detail from the Q3 financials. There was that weird spike in their effective tax rate. What was going on there?
Ah, yes, the tax nugget.
Yeah.
It's a bit complex, definitely an accounting thing, and not really an operational one.
Mm-hmm.
So their effective tax rate in Q3 25 jumped up to 20.8%, which looks high compared to 15.3% the year before.
Right.
The main reason was a one-time, non-cash deferred tax provision, basically an accounting adjustment.
Triggered by what?
It was triggered by new U.S. tax legislation, something called the One Big Beautiful Bill Act, or OBBB Act,
Yeah.
that was enacted back on July 4th, 2025.
Okay.
And this new law changed how companies have to account for the U.S. tax effect of certain foreign deferred tax assets. So they had to make this adjustment to conform to the new law.
So more of an accounting headache related to new regulations than a reflection of underlying profitability changes.
Exactly. Important to understand, but not a sign of operational trouble. Just complex tax rule changes impacting the reported numbers.
A necessary adjustment, then, even if it complicates the picture slightly, reflecting a new global tax landscape. Hashtag tag, 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 outro. Okay, so let's try and wrap this up. What does this all mean for you, the listener? We've basically seen a leader here with an undeniable strategic edge. Fueled by this explosive growth in cloud and particularly AI right now, their dominance in high-speed switching seems pretty solid, backed by technical leadership and strong financials.
True. But as we've discussed, that success comes at a price. It forces them to make these enormous forward-looking financial bets tied to the fortunes of just a few giant customers.
Right. So thinking about that massive $4.8 billion commitment in non-cancelable purchase orders.
Yeah, in a market where, let's be honest, the exact pace and timing of these huge new AI rollouts is still pretty uncertain, pretty volatile.
It leads to a key question, doesn't it?
It does. And maybe here's that provocative thought for you to chew on.
Go on.
How will that incredibly delicate balancing act, scaling up manufacturing fast enough to grab all that potential AI demand, while successfully dodging potentially crippling inventory write-downs if their biggest customers suddenly hit the brakes? How will that balance shape the whole competitive landscape in high-speed networking over, say, the next year or two?
It really is the ultimate scaling challenge, isn't it? High reward, but incredibly high risk if you get the timing wrong.
Exactly, the tightrope walk.
Something to definitely keep an eye on. Okay, thank you for joining us for this deep dive. We'll catch you on the next one.